Dear students, in this video let us discuss one more concept called dissolution of partnership firm. So we'll discuss with the accounting treatment for dissolution of partnership firm. What do you mean by dissolution? Dissolution, there are two concepts: dissolution of partnership firm and dissolution of partnership. First, let us discuss what is dissolution of partnership firm. Partnership firm, dissolution of partnership firm means complete closing down of the business of the partnership. Dissolution of partnership means termination of the connections with the firm by some of the partners of the firm, and remaining partners of the firm continuing the business of the firm under the same firm's name under an agreement. See the difference. There is a small difference. In this dissolution of partnership firm, all the partners are going to close the business, right? It's a complete closing down of a business. None of the partners is going to continue the business. Whereas in the second case, dissolution of partnership means here, see for example, if there are three partners, I think one may terminate from the partnership, and the remaining two are going to continue the partnership business. So this is called as dissolution of partnership. Whereas if the entire business got closed, no one is going to continue the business, then it is called as dissolution of partnership firm. Let us discuss the difference between dissolution of partnership and dissolution of firm. The first point, dissolution of firm, only some of the partners terminate their connection with the firm. Remaining partners, they continue the business. Whereas here in the dissolution of partnership firm, all the partners terminate their connection with the firm. Second point, dissolution of partnership may or may not bring the business of the firm to an end. See here, in case of dissolution of partnership firm, the remaining partners, I think out of 5 members, I think 2 members, if they resign or like if they terminate from the partnership, remaining 3 may continue the business, or sometimes they may not continue the business also. Dissolution of the partnership firm means it does not bring the business of the firm to, and it does not. Dissolution of the partnership firm does not bring the business of the firm to. It will bring the business of the firm to an end. Dissolution of partnership firm. Next point is it may or may not result in dissolution of the firm. It may also result the dissolution of the firm, or it may not result the dissolution of the partnership. Whereas dissolution of the partnership firm necessarily results in dissolution of the partnership. So this leads to dissolution of partnership, whereas this it may or may not lead to dissolution of partnership firm. Next one is a dissolution of partnership is voluntary, whereas dissolution of the partnership firm may voluntary, or sometimes it be because of the the court's direction. Court may direct for compulsory partnership. So therefore in that case it would be compulsory dissolution of the partnership firm. Next one, so under dissolution of partnership we will prepare a revaluation account. Under a dissolution of partnership firm we prepare realization account, because here the assets are sold, and whatever value asset realized, that they are being used for payment of all the obligations and their own partners capital. Whereas here the assets are revalued, and those profit or loss is going to be given to the distributed, of course, to the partners, especially to the partner who is going terminate from the business. Next, books of accounts may not close. So here, since a dissolution of partnership is not going to close the business of the firm, or it may not lead to terminate their connections with the firm, other partners will continue. So therefore it may not, the books of account may close. Whereas dissolution of partnership, since all are going to terminate their connections with the firm, the books of accounts are going to be closed. Okay, now circumstances or situations under which a firm is going to be dissolved. The first case, if the firm is formed for a fixed period, and if there is no agreement to continue the firm on the expiry of the fixed period. For example, a partnership is formed to continue for say 10 years, and if there is no agreement to continue the firm after that, after 10 years, then of course the firm is going to dissolve after 10 years. Next one, if the firm is formed for a particular venture or ventures, and if there is no agreement among the partners to continue the firm, then on completion of such ventures. So for example, if a partnership business is formed for a particular venture or a project, and after the completion of that project the firm is going to dissolve if there is no agreement to continue after the project. Next one, on the death of one or more partners, if there is no agreement among the partners to continue the firm. Yes, if one or more partners of the business, if they die, and if there is no agreement to continue the firm after the death of these people, or like after the death of the partners, then the business is going to dissolve. Next one, on the insolvency of one or more partners, if there is no agreement among the remaining partners to continue the firm. See, if there is no agreement in case of insolvency of one or some of the partners, and if there is no agreement to continue the business, uh, then in that case the business is going to continue, dissolve. One more is on the retirement of one or more partners. If any one or some of the partners retire from the business, in that case also it may lead to dissolution of partnership firm, provided there is no such agreement to continue the business. Sixth point, on the death of all the partners or all the partners except one. See, partnership firm is a firm where two or more members constitute a business. So, and therefore, if all the partners died, or if all the partners died except one, so in such cases the firm is going to dissolve. Next one, on the insolvency of all the partners or all the partners except one. Then on the retirement of all the partners or all the partners except one. On the happening of subsequent event which makes the business of the firm illegal. When the business was formed, it was legal, but after few years it has become illegal because of the government's decision. So in such cases the firm is compulsorily supposed to dissolve. So therefore, like in that case it will dissolve. Next one, by the consent of all the partners or by an agreement among all the partners. So if they have agreed to dissolve the business, so that will lead to dissolution of the partnership. And one more is by any partner giving 14 days notice to all the partners of his intention to dissolve the firm if the partnership is at will. So suppose if the partnership is at will, and if partner gives 14 days notice to all other partners to dissolve the firm, so there is a chance of dissolution of partnership. One more, by an order of the court in the following cases. So last one, the compulsory dissolution. So this is because of the order of the court. So the court will issue an order in following cases to dissolve the firm. The first one, when a partner has become insane, that is mad. When a partner has become permanently incapable of performing his duties as a partner. So in such cases, the court may decide issue an order to close the business. And one more is when a partner is guilty of misconduct affecting the business of the firm. When a partner does a guilty activity, guilty of misconduct, then which affect the business of the firm, so then in that case it will lead to the court to issue an order. When a partner frequently commits breaches of partnership agreement, then when a partner has transferred his share in the firm to a third party without the consent of all other parties, then when the business of the firm cannot be carried on except at a loss, since the firm is in loss continuously from past few years, and so in such cases the court will issue order. Then when the court is satisfied that it is just and equitable to dissolve the firm in the interest of all the parties, right? So if the court feel that like it is better to dissolve the firm instead of continuing the business, because if the business is continued, then it is not going to help anyone in the business. So in such cases the court will issue an order for closing the business. dissolution proceedings, the first step is all the assets are sold, whatever asset the firm has, all the assets are sold. Then in the second step, the amounts received from the sale of assets are used for paying the liabilities of the firm, and if there is any balance left, then these assets, they are used for paying the partners. So these are the three steps involved in dissolution proceedings. So this can be expected as a section A question. So here, continuing that, so settlement, how do the accounts are being settled? First one, the losses of the firm, including the deficiency of the capital, should be made good. If any partner has to bring the capital into the business, that has to be brought in, and if there are any losses, they are supposed to be made good. How to make them good? First one is out of the profits of the firm. Second one, out of the capital of the partners, and last one, out of the contributions of the partners from their private estate in their profit sharing ratio. So these are the three ways how the losses of the firm can be made good. The first one, out of the profits of the firm. Second one, out of the capitals of the firm, and lastly, since this is unlimited liability firm, so partners have to bring their shortage out of their private property. Then the second one, the assets of the firm, including the sums contributed by the partners to make up the deficiency of their capital, should be used in the following order. So now the assets are realized, and partners, they brought in the business, the deficiency in the capital. So then all this can be used for what? First one, paying the debts of the firm to the third party. The firm has any debt borrowed from outside, so then that has to be paid first. Then second one, in paying each partner proportionally what is due to him from the firm by way of loan. Suppose if the firm has borrowed any loan from their own partner, A, B and C, they have formed a business, and B has lent a loan of rupees 1 lakh and C has lent a loan of rupees 50,000. So in such cases, the loan has to be, these loans are supposed to be paid off. Then, and after that, if there is any surplus left, then in paying each partner's proportionally the amount due to him from the firm on account of capital. See, the first one is outsiders debt has to be paid. Second one, the partner's capital debt has to be paid. And third one, the partner's capital has to be paid. Then lastly, if there is any surplus, then it should be distributed among the partners in their profit sharing ratio. Even after paying the capital, if there is anything left, then that has to be paid. That should be distributed among the partners according to their old profit sharing ratio. Now, settlement of firms debts and private debts. So there we have discussed about the first one, the realized value is supposed to be used for paying the firm's debt and then partners debt. So let us discuss how it should be done. The first one, the assets of the firm should be utilized first in the payment of debts of the firm. This debt means debt belongs to outsiders, borrowed from outsiders. Second one, then if there is any surplus, the share of each partner in the surplus should be used in payment of his private debts. If he has private debts, or paid to him. If he has no private debt, then this capital has to be paid. Then private property of a partner should be used. See, suppose if the amount is not sufficient to pay the debts of outside, so in such cases, private property, they have to bring, the partners are supposed to bring it from private property. Okay, now how it should be used? First, in the payment of private debts, his private debts, then the surplus, if any, should be utilized in the payment of firm's debt in the case of firm's debts exceed the firm's assets. So if this private property what they are bringing in, so that should be first used for the payment of his own debt. Then if there is any surplus, should be utilized in the payment of firm's debts in case the firm's debts exceed the firm's assets. The assets realized are not enough to repay the firm's debt. So in such cases, the private property should be used for that. So therefore, look at the order, there is a difference. Assets realized, first it should be used for paying firm's debt, and then it should be used for paying the private debt. But here private property, first it should be used for paying his own private debts, and then it should be used for paying the firm's debt. Now difference between, as I mentioned earlier, one of the differences is like under revaluation account, under dissolution of partnership, we will prepare revaluation account, and under dissolution of partnership, we will prepare realization account. Let us discuss the difference. It can be expected for section E again. First difference, revaluation account is prepared when there is a reconstruction of an existing partnership firm, maybe admission of partner, retirement of partner, death of partners. In all these cases, we prepare revaluation account, and a realization account is prepared under dissolution of a partnership firm. Second point is, revaluation account is prepared only when the assets and liabilities of an existing partnership firm are revalued. If this revaluation takes place when there is an admission or retirement or death of a partner. And a realization account is prepared when the assets of an existing partnership firm are realized and its liabilities are paid off. See, the assets are sold here to pay the liability. So in such cases, realization account is prepared. Third point of difference is, a revaluation account is prepared to find out the profits or losses in the revaluation of assets of an existing partnership, whereas here they are prepared to ascertain the profit or loss on the realization of assets and payment of liabilities of an existing firm on its dissolution, right? See, here the realization account is prepared for finding out the loss or profit out of the assets which are sold. Okay, fine. Last point of difference is, revaluation account, the increase or decrease in the value of the assets and liabilities and the net profit or net losses resulting therefrom are recorded here. See, in the revaluation account, what we does is like increase or decrease in the value of the assets are recorded first, and the liabilities, of course, and the net profit or net losses resulting therefrom are recorded. Okay, here say for example, if there is a decrease in the asset, they are debited to the revaluation account, and if there is an increase in the asset, they are credited to the revaluation account. And similarly, if there is any increase in the liability, they are debited to the revaluation account, and if there is any decrease in the liability, they are credited to the revaluation account, and finally the profit is being found. But here in the realization account, the book value of the assets and liabilities and the realized values of the assets and the actual amounts paid for the liabilities and the expenses of realization, then finally we find out the net profit, okay, or net loss. So what we do is like, first we record the book value of the assets and liabilities. This is very important. This is the first step. So first we record the book value of the assets and liabilities as it is, then the realized value of the assets and actual amounts paid for liabilities are recorded, right? So then the realized values of assets are recorded in the credit side of the realization account, then the actual amounts paid for liabilities are recorded in the debit side, then the expenses again, if there is any expenses incurred on realization of assets, they are recorded in the debit side, and finally we find out the profit. See the difference between realization account and revaluation account. We'll work out some problems related to this. You can expect section B and section A as well as for section C the questions from this chapter. So this is very important. First problem. The following is the balance sheet of A, B and C who share profits and losses in the proportion 1:2 is to 1/3 is to 1/6 respectively. See, when you convert them into a common denominator, so 6 becomes the common denominator, and numerators the ratio 3/6, then 2/6, and this becomes 1/6, so that the ratio becomes the new old profit sharing ratio becomes 3:2:1. So this is the balance sheet, and these are the adjustments given. The assets realized are as follows: the buildings rupees 28,000, motor van rupees 13,000, furniture 6,000, stock 14,000, debtors 7,800, and goodwill rupees 3,000. See, when the assets are sold, this is the amount we have received. Okay, see, this is not realized, sorry, revaluation. These are the amount which are realized out of the sale of these assets. That you have to be very careful. So in case of revaluation account, what we do record in the revaluation account is the difference between the revalued the assets which is revalued and the book value. But here we are not doing that. First we record the book values of the assets and book value of the liabilities, then we record the realized values in the quite opposite side, and in another side, quite reverse to the side where we recorded the liabilities, quite reverse to that we record the liabilities which are paid. The expenses of the realization amounted to rupees 600. The sundry creditors and loans were paid in full. So here there are two outsiders obligation, creditors and bank loan. So it is they are paid full. Then an outstanding liability of 200 not included in the balance sheet was also paid off. There is an outsider's liability, outstanding liability, which was not recorded here, is to be paid off. Give the journal entries to give the effect to the above and open a realization account and bank account. Now let us do that. Okay, the first journal entry for recording the assets at their book value. So realization account debtor, 2 debtors account, 2 stock account, furniture account, motor van account, building. All the assets are supposed to be transferred to the realization account at their book value. This is very, very important. Now, second one, cash account debtor to realization account. Then I think in the adjustment we have the realized values. So all the realized values. So whatever assets realized. So when you sell them, you get the cash. So cash account debtor to realization account at the realized value of all the assets which are sold. So this is the sum of it. Okay, fine. 71,800. Their book value is how much? 65,400. But realized sale value 71,800. Now let us record the liabilities. Liabilities account debtor to realization account, including reserve for doubtful debt 400, which in the balance sheet it was there in the in the asset side under debtors. So now it should come under liability heading. So liabilities account debtor to realization account is very simple. See, realization account debtor to assets account book value record ಮಾಡುವಾಗ, and here liabilities account debtor to realization accounts. And when you pay up the liabilities, then it should be quite reverse to this journal entry. Okay, fine. Cash account debtor, these liabilities, see, look at here, realization account debtor to cash account while paying it. Okay, see, now the realized values of the values of liabilities are supposed to be paid in full. See, 12,000, 5,000 and 2,000 are recorded, paid in the form of 2 cash account. So here realization account is debited and the cash account is credited. So it's very simple to remember. First one, realization account debtor to assets account. Second one is cash account debtor to realization account. Third one, liabilities account debtor to realization account. And last one is realization account debtor to cash account. Next, we'll move on to the next journal. Find out realization account debtor to cash account. This is for the realization expenses paid. Then we'll find out the profit. Okay, now we got a profit after taking a difference. So realization profit is 6,000, that is distributed among the partners on the basis of their profit sharing ratio. Now seventh one is loans. Okay, out of this, okay, their obligations are already paid here. Sorry, in the fourth journal entry. Yes, loan. Sorry, what is the creditors and bank loan as well as that is what they are paid off. They are the outsiders obligation. Now after that the remaining amount is to be used for a partner's own debt, private debt. So that is paid here. Yes, loan account debtor to cash account. Then if there is any left, then partner's capital has to be paid. So A's capital account 23,000, B's capital 17,000, C's capital 11,000. So totally 51,000. So with this, I think the entire amount is being used, and no surplus is left to distribute among the partners as profit. Okay, now we'll prepare the realization account. Look at here. First, assets are recorded in the debit side at their book value. This is very important. So, book value will record ಮಾಡಬೇಕು debit side. Book value of the liabilities recorded in the credit side. Then realized value. See, two cash account. Realized values of assets are recorded debits credit side. Liabilities are recorded credit side. Okay, fine. This is very important. And cash account, this is 600 realization expenses paid. Say it's recorded in the debit side, and hence you find the profit of rupees 6,000, which is distributed among the partners according to their old profit sharing ratio. Listen, first book value of the assets are recorded in the debit side, book value of the liabilities are recorded in the credit side. Okay, then cash received out of the realization of assets recorded in the credit side, cash paid to the outsiders in the form of outsiders liability are recorded in the debit side. Then realization expenses debit recorded in the debit side in the form of two cash account, and finally you find out the profit. So these are the only items included in the realization account. First, book value of the assets are recorded, then book value of the liabilities are recorded, then realization of assets are recorded, then liabilities paid are recorded, then realization expenses are recorded, then finally find out the profit. How many are there? 1, 2, 3, 4, 5. Only 5 items comes. It's very easy for you to remember. Now let us prepare the A's capital account. Buy balance brought down 20,000 opening balance, and there is a profit of realization 3,000. So totally 23,000. His capital supposed to be paid is 23,000. So two cash account. Then B's capital account. So buy balance brought down 15,000, realization profit 2,000. So 17,000 has to be paid to him. Next, last one, C's capital account. Balance brought down 10,000, realization account 1,000, and cash account 11,000. So now we'll prepare the cash account. So look at here, balance brought down in the opening balance sheet, it was 23,000. Then by selling all the assets, we got this much, 71,800. This is total 76,800 is used for first paying the liabilities. Total liabilities were 17,800, 200. Then for paying the realization expense of 600. Then for paying the partner's loan, A's loan is paid 8,000. Then the remaining balance is utilized for paying the capital of the partner. So this is the process of how you have to follow, or so that you have to follow here. So first, what we do in the resolution. So these are the steps. You can expect this for section A. First one, we realize the assets. Then we use the realized value for paying the obligations, outsiders obligation, including the realization expenses. Then we pay the partner's capital or loan. Then we use it for the remaining surplus is used for paying the partner's capital. Thank you.